Hey everyone, welcome back to Corporate Dakota. Today we are diving into the financial statements of American Picture House Corporation. And let me tell you, there are some fascinating details that paint a very intriguing picture of this company's current state and future outlook. Buckle up for this wild ride. Before we dive into the nitty-gritty of this report, if you love getting these in-depth analyses of corporate filings without all the fluff, make sure you are subscribed and have notifications turned on. Also, we have a growing community on Discord. The link to join is in the description below, and it is a great place to discuss these findings and more. This is American Picture House Corporation's quarterly report, a look at their financial health and operations as of the 30th of September 2025. It is essentially a report card for the last 3 months and the first 9 months of the year. And as we will see, this report card has some very noticeable marks. Let us start by looking at the balance sheet. This is like a snapshot of what the company owns and what it owes at a specific point in time. As of the 30th of September 2025, American Picture House Corporation reported total assets of about $680,000. That might sound low, but it is actually down from over $1.1 million at the end of 2024. This decrease is largely due to a significant drop in produced and licensed content costs, which went from over $638,000 to $300,000. And loans receivable also saw a big decrease. Now, when we look at liabilities, which is what the company owes, we see a troubling trend. Total liabilities have jumped from about $1.19 million at the end of 2024 to over $1.8 million by the end of September 2025. This is an increase of over $500,000, driven by increases in notes payable, both related and non-related party. And this brings us to the stockholders' equity. This is what is left over after liabilities are subtracted from assets. For American Picture House Corporation, this section is not looking good. They have a stockholders deficit of over $1.1 million as of September 2025. This is a massive increase from a deficit of just over $16,000 at the end of 2024. Basically, the company owes much more than it owns, and this deficit has grown considerably. Now let's move on to the income statement, which shows how the company performed over a period. For the 3 months ending the 30th of September 2025, the company reported zero revenue, and that's the same for the same period in 2024. For the 9 months ending the 30th of September 2025, also zero revenue. But in the first 9 months of 2024, they did report about $23,000 in revenue. This lack of revenue is a significant concern. Their operating expenses are where a lot of the spending is happening. For the 3 months ending the 30th of September 2025, they had about $74,000 in operating expenses, compared to about $315,000 in the same period in 2024. This is a big cut in spending, which is good for cash preservation. However, they did have about $7,000 in sales and marketing expenses in 2025, while they had zero in 2024. Their net operating loss for the 3 months ending the 30th of September 2025 was about $74,000. Again, showing a big improvement from a loss of over $315,000 in the same period of the previous year. This improvement is largely due to drastic reductions in general and administrative expenses. Looking at the 9 months ending the 30th of September 2025, their net operating loss was about $1.3 million. This is an improvement from a loss of over $2.2 million in the first 9 months of 2024. The biggest reason for this improvement is a significant reduction in general and administrative expenses. These expenses went from over $2.1 million in 2024 to about $1.29 million in 2025. This period also included write-offs and expirations of assets totaling around $347,000. When we look at other income and expenses though, their interest expense has more than doubled in the 3-month period, jumping from about $12,000 to over $30,000. For the 9-month period, interest expense also increased from about $28,000 to over $52,000. This rise in interest expense is likely due to the increasing debt levels we saw on the balance sheet. Ultimately, for the 3 months ending the 30th of September 2025, the company reported a net loss of about $105,000. This is a substantial improvement from a net loss of over $326,000 in the same quarter of 2024. For the 9-month period, their net loss was about $1.35 million, an improvement from a net loss of over $2.2 million in 2024. And on a per S-hair basis, The loss is about 0.00 for the quarter and 0.01 for the 9 months. While these numbers seem small, when you consider the total number of shares outstanding, they represent real losses. Now let's talk about cash flow, which is arguably the most important aspect of a company's financial health. For the 9 months ending the 30th of September 2025, their net cash used in operating activities was about $325,000. This is an improvement from about $783,000 used in the same period of 2024. This improvement is largely due to reduced operating expenses and some significant write-offs of uncollectible loans and expired rights. Investing activities for both periods were minimal. However, financing activities provided a net cash inflow. For the 9 months ending the 30th of September 2025, they had about $427,000 in cash from financing. This came from related party borrowings and new debt financing. In the same period of 2024, financing activities provided about $601,000, which included proceeds from stock sales and borrowings. The company's cash and cash equivalents at the end of September 2025 was about $101,000, a significant increase from zero at the start of the year, as they managed to bring in some cash through financing. American Picture House Corporation, also known as AFP, is focused on developing financing and producing feature films and related content. They have changed their name and state of domicile several times since their incorporation back in 2005, most recently changing their name to American Picture House Corporation in December 2020. They operate as one business segment. This section is critical. The report states that due to a working capital deficit and accumulated deficit, there is significant doubt about the company's ability to continue as a going concern. This means they may not be able to operate for much longer without additional funding. They have very limited operating history and reported virtually no revenue in the periods discussed. They expect further losses and cannot assure profitability. They have loan agreements with the company's CEO and a trust controlled by the CEO to fund their cash needs. This is a major red flag. This note details their borrowing activities. They have notes payable to their CEO, Mr. McGregor, and the Noah Morgan Private Family Trust, with interest rates around 4.4%. They also have a commercial line of credit with American Express with very high interest rates ranging from 16.09 to 34.3%. And this line is personally guaranteed by Mr. McGregor. Additionally, they have a new unsecured promissory note for $115,000 with Labourers Fund II, LP, that matures in 12 months. Crucially, they have also entered into an equity line of credit with RH2 Equity Partners, LP, which allows them to sell shares of their common stock over a 24-month period for up to $100 million. This could provide much needed cash but would also dilute existing shareholders significantly. This note highlights transactions with individuals or entities closely tied to the company. The CEO, Banner Michael McGregor, has agreed not to convert preferred shares into common stock for 90 days to provide stability. The company also incurred professional fees to a legal firm affiliated with a board member and paid consulting fees to board members. Notably, the CEO has waived his consulting fees for the year. Mr. McGregor also expects to receive producer credits on third-party film titles, which do not entitle him to compensation separate from AFP's arrangements. This section offers management's perspective on the company's performance. A significant development is the agreement with SSS Entertainment LLC to extend an option on the film Turn Up the Sunday and acquire rights to the film Barron's Cove. As part of this deal, the company issued 500,000 shares of its common stock. Interesting to note here is that by acquiring Barron's Cove, the company will pay SSS the first 85% of revenues until SSS recoups $2 million, after which AFP will retain all such revenues. This is a revenue sharing agreement that could impact how much cash actually flows back to the company. There have been some leadership changes. Jonathan Sanger resigned as president and Donald J. Harris resigned from the board of directors. These resignations were said to be unrelated to any disagreements about the company's operations. The entry into the equity line of credit with RH2 Equity Partners, LP, is highlighted here as a way to enhance liquidity and financial flexibility. However, they acknowledge that any issuances would dilute existing shareholders and could pressure the stock price. The company has a history of name changes and stock splits, indicating a period of restructuring and attempts to reposition itself. They focus on developing financing and producing feature films and limited series, with a strategy of mitigating equity exposure by structuring projects with external funding sources like sales, and production incentives. Looking at the 3-month period, revenues were zero in both 2025 and 2024. Their general and administrative expenses dropped significantly by about $248,000. This shows a strong effort to cut costs, which is essential for a company in their position. Sales and marketing expenses increased slightly. Their interest expense more than doubled, reflecting their increased borrowing. For the 9-month period, revenues were also zero in 2025, down from $23,000 in 2024. General and administrative expenses decreased by a substantial $904,000. This period also included significant write-offs such as a $196,200 loan write-off and a $150,834 write-off for an expired screenplay. This indicates a cleanup of problematic assets. This subsection is probably the most concerning part of the report. The company acknowledges they have significant liquidity challenges and believe there is substantial doubt about their ability to continue as a going concern. They had about $102,000 in cash at the end of September, but face current liabilities of about $1.7 million. They are relying on their equity line of credit and potential bridge financing to fund operations. However, they stress that availability under the equity line of credit is not assured and any issuances would be dilutive. This is a clear warning sign that the company is in a very precarious financial situation. This section is not required for a smaller reporting company, which American Picture House Corporation is. So, nothing to see here. They've admitted that their disclosure controls and procedures were not effective as of the 30th of September 2025. They cite material weaknesses like insufficient accounting personnel, inadequate segregation of duties, and insufficiently designed controls. They are implementing steps to fix this, including quarterly reconciliations and enhanced monitoring, but it will take time and funding. The company is facing potential arbitration claims from two former consultants, Jonathan Sanger and Michael Jones. They are disputing contract compliance of service and awaiting further action. There are no material changes to the previously disclosed risk factors. This implies that the risks they previously identified are still very much present. This lists all the supporting documents filed with the report. Most of these are agreements and legal documents related to their various loans, credit lines, and stock plans. Now, let's talk about what all of this means. American Picture House Corporation is clearly in a tough spot. They have very little revenue, significant debt, and a growing deficit. Their strategy seems to be focused on cutting costs drastically and securing new financing, particularly through their equity line of credit. However, the going concern warning is a serious red flag indicating they might not survive without significant financial inflows. The company is heavily reliant on its CEO and related parties for funding, which can create conflicts of interest and a lack of independent oversight. While they are taking steps to improve their internal controls, it will be a long road. The lack of revenue, coupled with increasing interest expenses, paints a picture of a company fighting for survival. Their ability to successfully produce and market films will be critical. But without substantial funding, even the best projects can fail. The equity line of credit offers a lifeline, but at a significant cost to existing shareholders. It is a high-risk, high-reward scenario for any investor. So, what is my take on American Picture House Corporation? They are a company in distress, trying to find a path forward in a very competitive industry. Their core business of film production has inherent risks, and when layered with their current financial state, the picture becomes even more challenging. The company's survival hinges on their ability to secure substantial funding and execute their film projects successfully without burning through that cash too quickly. The significant related party transactions and the CEO's substantial voting control also warrant close observation. It is a company with a lot of potential upside if they can navigate these challenges, but the downside risk appears to be very high. What do you think about American Picture House Corporation's financial situation and their strategy to overcome it? Let me know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and I'll see you in the next video.